the key difference between a multi-asset trust and a single asset class trust is asset allocation. Multi-asset trust is allocating across a number of different asset classes. And so one of the key roles is to decide how much to allocate to each asset class at different times of the cycle. There will be times when it's important to be heavily allocated to cash. At other times, it'll be important to be heavily allocated to risky assets, such as equities. And deciding when to be allocated in certain ways to different asset classes is a very important part of what we do. And you can think of that as adding value to a client's portfolio. You can think of it as trying to mitigate the effects of a downturn on clients' portfolios. In fact, that's exactly what we're trying to do at the moment. We see that the world economy is moving closer towards the end of the business cycle, and that's the point at which risky assets such as equities will start to perform quite poorly. And we want to make sure that we've reduced our exposure in the trust to risky assets such as equities, such that by the time the bear market arrives, the fund will be well positioned to benefit from that lower allocation. So we think that that's a major part of what we do, and we're acting very carefully to try to position the trust accordingly. Trust is an interesting balance between a structure which would be what you call a balanced fund, comprising just equities and bonds, and on the other hand, something that is a bit too complicated, where people look at the portfolio and see that there are certain instruments that are difficult to understand, whether that's derivatives or structured products or other slightly esoteric asset classes. And we invest, apart from equities and bonds, we invest in what we call specialist assets. For example, we have a couple of aircraft investment companies. These are trusts that invest in aircraft such as the Airbus A380, Super Jumbo, and another trust invests in the Boeing Dreamliner, the 787. And these trusts buy the planes and then lease them to operators. And the way they make their money is by receiving the lease payments from the operators, but there's also scope to generate returns from the capital appreciation of the aircraft. These trusts are yielding about 8%, slightly more than 8%. And then on top of that, you could get returns as a result of the capital appreciation of the aircraft, taking total returns up to mid-teens, according to our estimates. So those are very interesting. Our REIT holdings are not focused on the big bellwether companies, but very focused REITs. That's focused. It could be focused in terms of the type of property. So we're not really talking about commercial or retail, but it could be healthcare or it could be retail warehousing. And there you've got some really interesting opportunities, some really decent yields. It could be non-core in terms of geography. So you tend to find that there are more interesting opportunities outside of the southeast of England where property is quite expensive. So the point is just about being really focused with your investments. Elsewhere, fixed income, we're not invested in any developed market government bonds. We think are horribly expensive. Despite the recent rise in yields, they're still generally very low or negative in real terms. But there are other opportunities in fixed income, such as emerging markets, where you've got very good yields, and also emerging market economies are also quite healthy at the moment. So hopefully that gives a flavour of how the trust is structured, but also some examples of the sort of investments that are in the portfolio. So our investment style we call multi-asset value investing. This is a term that we have coined ourselves. It's unique. You won't find anyone else using this term. And essentially what we're doing is we're saying that every single one of our investment decisions, whether it relates to asset allocation or our decision to buy a particular UK company or our decision to buy a particular REIT or infrastructure fund, is based on us having identified an undervalued situation, a market that's undervalued, a UK company that's undervalued, a REIT that is undervalued. And equally with asset allocation, it's as much about avoiding asset classes that are overvalued. So we're taking the core principle of value investing as laid out by Graham and Dodd in the 1930s, which is essentially about buying things cheaply, and saying, well, actually, you can apply that to every investment decision. And the idea is if you buy something cheaply, you've got a much better chance of making money than you would if you're buying something which is expensive, and therefore you're relying on something becoming even more expensive, which is quite a big ask. So it's a simple idea, the idea of buying something cheaply. As far as how the team is organised is concerned, we've got a number of fund managers. Each of them is responsible for one of the areas where we're making investment decisions. So I am responsible for asset allocation. My colleague Mark Wright is responsible for UK equities, etc., etc. And because the entire team is involved, it means that it genuinely is a team effort, the management of the investment trust. Every single team member is responsible in some way for the performance of the trust. And that's important because multi-asset, you're covering every asset class and you're generally covering the entire world. So you need to be well organised. You need to make sure that you're making full use of resources. So we think we've got a very well organised team. The investment objective of the trust is we aim to achieve a real return of 6%. That means 6% over and above the consumer price index inflation over a typical investment cycle. Now, what does that mean? Well, you can get investment cycles where the performance of key asset classes such as equities or bonds can be very poor. You go back over the last 100 years and there have been investment cycles where returns from bonds have been significantly negative because inflation has been high and rising. And also during those types of cycles, returns from equities can be quite poor as well. And in that sort of cycle, it is very hard to achieve an objective of CPI plus 6%. So really what we're trying to do there is to guide our clients' expectations, to help them to understand that it's going to be hard for us to achieve a real return of 6% in a cycle where returns are very poor. But in a normal cycle where returns are in line with their long-term averages, then we think that we would be able to achieve a real return of 6%. And that 6% is a combination of what you're getting generally, the returns that you're getting generally from markets, as well as the returns that are attributable to the decisions that we are making, which could be either to be overweight a certain asset class or underweight, or a decision to invest in a particular company or a particular fund. So the combination of all those decisions and the backdrop of what markets are doing, that is how we would expect to achieve the objective. Control mechanism is a mechanism which enables investors to either purchase shares in the trust or sell shares in the trust very close to net asset value. And the way that works is that the trust will issue shares at a slight premium to net asset value. And if investors want to sell shares in the trust, they will buy those shares back at a slight discount. So hopefully it gives investors the reassurance that they will have the liquidity there if they need it. One of the key risks to investing in investment trusts is the risk of discounts widening sharply, and that can have quite a bad impact. So by introducing a discount control mechanism, we will hope to prevent that from happening, and that should enable the demand for the trust to remain quite buoyant.